Welcome to the Finance Podcast. The topic of this episode, The Future of Investment Industry by Jakob Schaad, Christoph Künzle and Cyrill Moser, moderated by Mirjana Wojtal.
Welcome to our panel on the future of investment industry. My name is Mirjana Wojtal. I am the CEO of CFA Society Switzerland, and I have incredible honor to moderate the panel today. For those of you who are less familiar with CFA Society Switzerland, we are the largest association of investment professionals here in Switzerland with more than 3,500 members. We are also part of the global network of more than 200,000 CFA charter holders. Our mission is to lead the investment industry by fostering the highest standards of ethics, knowledge, and professional excellence in the investment industry for the ultimate benefits of the society. Now, I think everyone agrees with me that investment industry is at a fascinating moment. We are entering a new, uncertain, and very transformational era. And we are seeing our industry being reshaped by some very powerful forces: technological disruption, demographical changes, political, geopolitical tensions, regulational shifts, and of course, ever-evolving investor expectations. I have three great experts with us today to discuss those topics. So on your left, Cyrill Moser. He is a CFA charter holder on the executive board of ZHAW, but also on the board of CFA Society Switzerland. You can actually find their biographies, detailed biographies, on the Finance Messe website. But Cyrill is bringing client-focused perspectives to this conversation from the front lines of asset and wealth management. Dr. Jakob Schaad, who has decades of experience in policies and practices, and he will bring his insights into the intersection of economics, financial markets, and regulations. And finally, Dr. Christoph Künzle, who is also a CFA charter holder, who combines academic insight, as he is lecturer, professor at ZHAW, also a researcher there, and he is also director at Deloitte's Financial Services Strategy Practice. Correct?
Yes.
Good. So if you have any questions for our panelists during our discussion, feel free to raise your hand and ask questions. So rather than running through the questions, we really hope to take you on the journey today. We will start the discussion with where we are now, and then we are going to look ahead at the trends that are shaping our industry. We are going to talk about how firms, organizations can adapt to those changes. And finally, we will reflect on the people who make it all happen, so investment professionals. And now, as mentioned, before we talk about what's coming next, it's important to understand where is the investment industry today. So first question, Cyrill, to you. How do you assess the landscape of investment industry today? And if you can please comment on challenges that clients have these days to select asset managers or wealth managers.
Yes, thank you, Mirjana, and thank you for being on this panel. I felt very, very humbled to be on the panel with the title, The Future of the Investment Industry. So very glad to be here. First of all, I think the good news is that for investors, there is a huge supply of asset managers. The FINMA just recently updated us that they are processing 1,700 applications for portfolio managers, asset managers, trustees. Now, that number might be down from numbers we heard 10 years ago, around 2,500, but 1,700 asset managers in Switzerland is actually still a pretty big number. And the consolidation will go on and succession planning, etc. But I think the supply is there. I think the demand is also there. Again, recent figures from AMAS tell us that there's 3.4 trillion Swiss francs in discretionary mandates managed by Swiss asset managers. So I think the supply is there, the demand is there, but how do you get the two together? How do you find an asset manager? And I think here it depends really which client segment you look into. Also from my previous experiences working at a large bank, if you're in an ultra high net worth segment, and most banks define that starting somewhere around 50 million bankable assets, ultra high net worth, family offices, multifamily offices. If you're in that category, you generally have transparency. People vying for your business, they're coming to present to you. You know what the performances are of the different asset managers. You know what the costs are, and you're pretty competitively priced normally. But if you are one of those, we call them poor millionaires, in the high net worth segment, somewhere between 3 and 30 million, it's very difficult to get transparency. It's very difficult to compare offers on prices, on performances, and also on investment philosophies. I mentioned the 1,700 before. So that's a bit where we come in, and as a company, but we firmly believe that this transparency, which is still at the very beginning in wealth management, is a current state that will change. And of course, transparency is usually good for consumers. It's usually bad for suppliers because of the margin transparency, the margin pressure. And I think that's one of the developments. Banks might not like this, but this is one of the current states that we see.
Okay, thank you. And Jakob, what do you see as the biggest, what's making the biggest pressure on the industry today, especially regarding the regulations and economic pressures?
I think regulation, it's probably regulatory complexity. I think that has been going on for quite some time. But what we now have in addition is actually regulatory uncertainty. And I'm going to talk, that's the regulatory world. And then economic pressures, we might be actually in a time where the financial system will go through revolutionary change. And there also we are faced with a lot of uncertainty. So I'll start with the financial system today. I mean, I've been looking through this paper from Stephen Moran, who is the chair of economic advisors of President Trump, where he basically devises how the financial system should be rebuilt to share the burden of the US dollar being a reserve currency, and hence an overvalued dollar leads to misery and deindustrialization and everything. And that is the system of tariffs and also monetary measures. So if we are really going to see that, that means really a lot. Because what does it mean for the Treasury, the US Treasury? That's really a benchmark. What does it mean for us then if we don't have that kind of benchmark yet? I don't think they really want that, but it may turn out that way. And certainly when we have this uncertainty. I already disagree with the analysis of Stephen Moran, where he thinks that it's the overvalued dollar that is responsible for the deindustrialization in the US. If you look at the Big Mac index, then the Swiss franc is 38% overvalued towards the dollar. We have not had deindustrialization on the level the US had. So anyway, that is the economic things. I think we're probably going to talk about that later too. And then regulatory complexity. You mentioned geopolitical developments.
Yeah.
Sanctions has been a big thing now. So what you need to do is really, as an investor now, especially if you are in the private markets, you need to also look at sanctions because you need to look at your supply chain. So somewhere in your supply chain, you may have someone who is sanctioned somewhere in some jurisdiction. So we have this fractioning of financial markets that we need to deal with also in the regulatory space. So you better get some legal opinions when you are an entrepreneur yourself to see whether your supply chain is actually legal or not. So I think that we can talk a lot about the financial system. Really, we have a lot of uncertainty. Today is Liberation Day, so let's see what that liberates us from. Let's see.
Is anybody going to wait 10 o'clock for the announcement? No? Tomorrow morning you prefer to wake up with the news? Okay, so we are going to turn the gaze forward. Christoph, what do you foresee? How will technological advancements change the investment industry in the next few years?
Yeah, that's interesting. I can speak a bit for the private banks and how this is changing. Just to echo Cyrill's impressive 1,700 EAMs, a similar situation in private banking. So we still, in our last study, we count 66 Swiss private banks, which does not include any cantonal banks, but that is still a lot. It may have been more 10, 15 years ago, but 66 private banks for a relatively small country is still a lot of supply. And as I see technology definitely impacting the client interactions, the client interface, making that more productive, more effective, more efficient, without, and that's a key message, without really making the RMs redundant. I very much believe this will remain a people's industry, so the RM will not be replaced anytime soon, at least in the sort of core private banking space. But there's a lot going on in terms of AI to make the RM better prepared, more effective, more efficient, more personalized. Just this week I was presented with a quite astonishing fintech, and what they did as an example, they developed a solution that the RMs would have on their tablet. It listens into the client conversation in real time and suggests or prompts the RM with investment opportunities as they speak with the client, depending on where the conversation goes. So that is quite astonishing and could direct towards a future that is still human-centric but digitally supported. Probably also data will be a big thing. I think banks need to be much better at harnessing their data, become data savvy, as we say. If I think of my personal life, I order one pair of shoes on Zalando, or I watch a YouTube video, naturally next time I go to that site, I'm prompted with things that could be relevant, and banks have not really done that, right? Even though they would know so much about us, pretty much everything, if they properly managed and leveraged the data, so they haven't done that. Okay. I think, plenty of disruption opportunities ahead.
So I think you just mentioned personalized services that should be offered, and you talked about transparency. So how do you think that will change the industry going forward?
Yes, I mean, this is maybe a bit of marketing about my company, it's my wealth, but this is what we do, right? We provide transparency in a corner where there is there is not a lot of transparency. That's why the margins of a lot of banks are pretty juicy in this high net worth area. And I agree. We firmly believe that transparency and the use of platforms is something that will only increase. If I buy a new tennis racket or a golf club, I go on Amazon and check the prices. If I book a hotel, I go on Booking.com. I go on eBay and I go on Zalando to, check out the latest sneakers. And wealth management is still in its infancy in this area. And of course, the private banks would like to keep it that way. This is where their biggest margins are. They're not in the ultra high net worth area. They're not necessarily in the retail area. They're in the high net worth area. So that is definitely something we'll see, and I think the banks will have to deal with this, increasing transparency.
Okay. I have a following up question for you. What does the rise of retail, the rise of index or passive investment means for asset managers?
Yeah, I mean, it's a huge question. Lots of debates with lots of active managers about this, right? Yes, 2024 was the first year that in the US, the amount of passively managed assets was bigger than the actively managed part of the 9 years of bigger inflows into passive instruments. But at the same time, I'm sure a lot of people that sitting in here have also read this famous book, A Random Walk Down Wall Street. Burton Malkiel published it in 1973. This is over 50 years ago. 50 years ago, this man showed research that basically said that a blindfolded monkey was as effective in picking stocks as an active manager. This is more than 50 years ago. I nevertheless started a career as a sell-side analyst 15 years later. But, it's 2025 now, and yeah, I think we see this passive investing continuing to rise. Yeah, it's also a fact that only 22% of passively managed funds, 22% of actively managed funds that survived beat the index over 10 years, over a 10-year period. Yeah. Now, does that mean the active management is dead? No, absolutely not. I don't think so. I think it very much depends on what you as a client, what the investor is looking for. Mm-hmm. Yes, if you're trying to beat an index and you want to do it at a cost-efficient way, there's probably no way around, over the long term, a passive investment. But a lot of investors have different goals. They're looking for different things to challenge. Maybe they're looking for an ESG special portfolio. They're looking for a high income, dividend portfolio or something else. And especially in periods as we've seen it right now as well, high volatility. This tends to be an area where active management, has a little bit of an edge. But I also would like to say, I think, the oncoming move in artificial intelligence is going to make it harder and harder, in my view, for active management. Yeah, if we think back years and years, why did active management generate alpha? Analysts had, a way of maybe extracting some news from some CFOs at the time. There was just built-in alpha that's not there anymore. And it's going to get more and more difficult. The more large language models you have, the more AI models you have that are basically, taking away this alpha and will probably maybe shift even more assets towards passive investing.
I think actually what the analyst with an active fund is providing is public information. It's a public good because that's visible in the market, and that means that passive investors can just follow. So basically, I think as an economist, we have an equilibrium where there are too many analysts providing that public good, and the followers actually benefit. But that, as you said, with artificial intelligence, models get better, and it's getting even more difficult for those analysts to make an edge on it and really make money with it. So, yeah.
Mm-hmm. And Jakob, as economist, what do you think? What role deglobalization and socioeconomics imbalances are going to play?
Wow, okay. First, are we going to see deglobalization? That's the first question. So probably yes, at least it's the goal of the current US administration. So we might see, and we're already seeing it to some extent already now with the economic warfare that is going on with sanctions and so forth, that financial markets are going to fragment after they have been growing together. They're refragmenting again, and so what we possibly could see was just blocks around, but blocks not only around economics but also about security. That's also something that Stephen Moran was philosophizing about in his paper, where actually the provision of security was also part of the whole package. You press people with tariffs, and if you want to have a special deal, then you get security. The same thing with turning U.S. treasuries into 100 years bond without interest, and you're paying with a security. There's some crazy stuff in there, really, because anyway. So this is a new world. I don't know yet how we are going to deal with that. Then socioeconomic imbalances, that's what I was talking all about before, because we are living in aging societies, I would say even globally, or almost only globally. And that, in an aging society, you have all those baby boomers, with people like me going into retirement. Maybe not me, but theoretical people are starting to go into retirement, and they are turning from savers into consumers. So, and this seminal lowering of interest rates is probably one of the consequences of aging. There you have the interest rates are getting smaller. That puts pressure on pensions. And pensions is another thing. You had this 13th AHV pension that was voted for because pensions are getting insufficient. So that's one thing we need to deal with it. But this aging of society also has an aspect of the labor market. It also means that even in the financial sector, where it has been easier to recruit, and I think it still is, it's going to get more and more difficult. So we need to deal with that somehow. We still have some people who, you want some only young guys or a young team and so forth. Well, go look for young people and that are willing to do the job in the amount that you need. Of course, AI can probably replace a lot of your workforce, but not everything can be done by a machine. You still need someone who has the oversight and the understanding of the whole problem to feed the right stuff into the machine, even if the machine gets better and better. So, deglobalization, yeah, that's going to be quite different. I think those countries that are aggressively deglobalizing because they think that will help their manufacturing sector or whatever, I think they're going to have a rude awakening because historically this wouldn't be the first time that has been tried, and usually it had been pretty bad for the countries that went into that. So even what the US administration wants to do could lead to a few blocks, but it could also lead to isolation of a few countries who want to do their own. And there, I'm pretty sure that that will be very detrimental for their populations.
Just perhaps a very concrete outcome of that for Swiss private banks is the stagnation of international assets, right, of flows, what we used to call offshore assets. I'm not sure, there's a famous Deloitte study that comes out every 2 years where they compare international wealth centers, as Switzerland is still at the top, but we're likely to lose that top spot. And if you look at the international flows, overall, globally, over the last 15 years, have been absolutely flat, have not grown at all. So it seems clients are more and more booking onshore in their countries or regionally, which means for Swiss banks, they go where the growth is, which is APAC or other regions, but the flows to Switzerland have been quite stagnant. Yeah, that's perhaps an outflow of that deglobalization.
I'm pretty sure. I think some people are bringing their gold out of the US, for example. Actually, the Swiss National Bank, I used to work with the Swiss National Bank. Swiss National Bank did that like 15 years, 20 years ago. They brought all the gold out of the US. Used to be in Fort Knox. No more. So, we had a bad experience. So, anyway, that is probably going on. I wasn't aware that was going on to that extent. But, I mean, what does that mean for the financial center in Switzerland as the biggest offshore market?
Yeah, we'll perhaps come to that, yeah.
Okay.
Yeah.
Any questions? No? Okay, so do you think there are any other trends that are going to change the industry? There are many.
How much time do we have?
What do you think is most significant?
Yeah, I mean, loads of trends. Yeah, I mean, it's hard to sort of start somewhere. I think when we talked before the panel, we talked about ESG and sustainability, and maybe it's something to touch on, because it's certainly something that has been established. It's here to stay. We as a company, we're a small company. We see actually currently very little demand for sustainability mandates, I have to say. But I firmly believe that humanity will cut the corner, and capitalism will rein in, and basically companies will be fined and punished at some point sufficiently so that there is, an embedded sustainability happening at the end of the day. That will be unnecessary maybe to have a specific fund for ESG or sustainability, because at some point, it will be embedded. That's my view. But I mean, it's just one of the topics. I think I'll let the colleagues maybe.
In the end, everyone is ESG, right? I mean, it happened with political parties where you still have a Green Party and so forth. But I mean, everyone is doing sustainability in some way. Although I'm not sure right now what's going on. We have some backlash here. But I think in the end, climate change is happening. I don't think it helps a lot if you suppress science and go through all the universities and root out all that stuff that you don't like. It's still going to happen. So
I didn't want to deny climate change.
No.
Quite the opposite.
I wasn't alluding that. No, actually, that means that everyone will do it in the end.
Yes,
without labeling it.
It'll be hard to.
And then an ESG fund will be not much different from another fund. But in the meantime, not so sure it's going to happen right now. Maybe a little later. But then, in the long run, 4 years. Well,
or in 8, or in
8 or whatever. How many terms? No, actually, I was going to say something about your idea about capitalism. I also agree with that. That I think that is pretty clear nowadays. I also think that capitalism maybe is a term that is not a very useful term, because we have institutions are very important, and the pure capitalism it's not. You need some institutions to regulate the markets, and you get an advantage out of that. But what we see now is a competition no longer between socialism and capitalism, but between liberal capitalism and authoritarian capitalism. And I'm not so sure where we're heading now. Right now, we're heading towards authoritarian capitalism. I think authoritarian capitalism, it's Milanovic who was coming up with that theory, but I think in the end, that's actually a suboptimal capitalism, because in the end, it's crony capitalism, and you won't really have the rule of law. And if there is anything that is established, is that the rule of law is extremely important for wealth, for development, for the wealth of nations. So I think capitalism here to stay. Authoritarianism, let's see where it heads.
And perhaps a trend flowing out of the digitalization of the tech we've been talking about is very different, or new client profiles, again, for private banking. And to use another politicized term, wealthy people used to be elderly white men. Typically, if you go to banks, the client profile is 70, 80 plus, male, white. And that is changing quite a bit with tech and social media and crypto and so on. There's very new sources of wealth where young people can become fabulously wealthy quickly. And the whole private banking setup still seems a bit geared towards the old clientele with very, very personal and very traditional, and also elderly sales force, often very traditional surroundings. And that often does not seem to match anymore with that younger type of client. Female wealth is a big topic. Female entrepreneurs, social media influencers that come to a bank as multimillionaires and do not necessarily find the perfect match.
Great. I think this is a good intro for the next topic, where we will talk about how companies adapt to all of those changes to remain relevant, competitive, and resilient in face of everything that's happening. So then question for you, Christoph, what are the organizational changes that are essential for the companies to be able to meet client needs?
In a nutshell, what I would say, they need to make peace with technology a little bit, and I can speak for the bottom half of the many private banks, not the UBSs of this world, but the smaller ones. I still very often see a very traditional setup where they would even actively not do any digital initiatives or anything. They would say, we have client advisors, and it's very personal, and we do this over a coffee, and this is how we do business. Which I say that may be fine from a strategic perspective, but I always tell the same story. My elderly father is way over 80 years old. Even he would use a tablet over the weekend to check his investments and maybe send a quick message to an RM or so. I think a certain digital capabilities are just expected. I think that would be a big step if banks at least started to offer some sort of multi-channel functionality, and the digital bank, online banking, to look into maybe the capability for clients to enter their own trades. I think that would be a big step forward already.
Mm-hmm. And then, Cyrill, follow-up question on that. What strategies should firms adopt to gain client trust?
Yeah. So maybe a bit from my experience also, and a focus on the asset manager. Yeah, we talked about the 1,700 licenses that are out there. What I see is, there's a lot of good asset managers out there, but there's also a lot of naive asset managers out there. Asset managers that, still maybe afraid of, showing their performances or going into a comparison, but also that haven't really done a very good, I think, competitor analysis. Yeah. Mm-hmm. So it starts with USPs. Yeah. I think of the 1,700, probably 1,600 would have independent as one of their USPs. Yeah, and I mean, if 1,600 say that they're independent, it's not really a USP. The U actually stands for unique in USP. But this is something, yeah, and most of them are probably not even independent because of their custody bank relationships and research products. But, you know, so there is, I think, still a naivete from a lot of asset managers, and I would urge asset managers to really go deep into their business plans, their analysis of what they actually want to do. Focus on what they're really good at. Yeah, specialized asset managers, we believe, have you know, a better future. You can categorize them, you can identify them quicker than somebody who does everything a little bit for everyone everywhere. So we believe that specialized asset managers is something, and certainly asset managers that know what their competitor field looks like. I agree with the technology. The technology is just coming. It's like if you wouldn't have used the internet 15 years ago, you would be gone. If you don't use the current technology that's available to you, you're probably gone in 10 years. So I think I agree with what Christoph says. You need to really be friends with technology as well that's available to you.
So companies need to be innovative. And
they need to be innovative. They need to also know their competitive environment. We see still a lot of asset managers that do not really understand their own competitive environment. They think they're way better than they are.
Okay.
And they haven't really done the analysis properly. And if you ask them about their elevator pitch for 30 seconds, they're struggling. And you ask five people of the same company, you get 5 different elevator pitches.
Okay.
It's all unique and client-centric and independent.
Yeah, exactly.
And companies want to grow, right? So, Jakob, how could companies effectively navigate all the regulation complexities that you mentioned to pursue this growth and innovation?
I think first, what you were talking about, technology and skills, I think it takes both. You need to use the technology and use the technology and understand it, because I still think even now a lot of things really need to be done with the help of a machine, right? But you need to understand what the machine is doing. Anyway, regulatory landscape, I think that's getting more complicated. And I was saying, complexity, we had that before. Now we have uncertainty. So I think what you need to do now is really to understand your environment, also the economic environment. I would do scenario analysis. And that's what I do, where I actually also advise companies, because I'm also in the board of a few companies, is to do scenario analysis and understand what the implications of the different scenarios are, and then try to understand, get a touch which scenarios are more likely than others. And if you have absolutely no idea, then you need to navigate in a way of uncertainty. That's one thing. The other thing is, if you're dealing with clients across the world, again, you need to deal with sanctions, this economic warfare that is going on. There's a lot of people that, the list of sanctioned people is getting longer and longer, and it's really hard to, and then some get off the list and some are put on the list. You need to follow that, because you can get really in trouble if you're not doing that. So I think that's what you need to do. And then what I also advise, actually also in the same customer space, is to have an issue management. Depends where if you're only active in Switzerland, it's maybe not as dangerous as elsewhere. But if you do, and then you should actually, or you can use issue management that is also aided by machinery, scrolling through the network. We use a provider that scrolls through the internet, organizes the information, where you can get sentiment analysis. You can also get the chats all over the world in the different channels, social media, open registries, that talk about regulation that is coming on and so forth, and you can prepare for that. I think that is probably most important for people who are catering B2B, because you don't want to be the person who overlooks something and gets caught in a scenario that was maybe more likely than you thought.
Good. I think we are now going to move to the most interesting part, and it's about investment profession, really. So how can we equip the next generation of professionals coming to this industry, and what can we do for all the seasoned professionals in this room so they continue to drive in the industry? Cyrill, so what do you think, what skills, what mindset and values are essential for investment professionals in the years to come?
Yeah, I think a lot of the skill sets and mindsets will be the same. Yeah, I think it will depend a little bit where you sit in the value chain of the investment process. I still believe, despite all of the digitalization, there is a human element with a lot of clients involved. So people skills, if you're at the end where you sit down with a client, where you need to have listening skills and analytical skills to be able to understand what a client is saying. So I think that will remain important if you sit on that part of the value chain. Obviously, as always, a good technical understanding of what's going on, of markets. A lot of things have not changed. I think, we needed to know 30, 40 years ago how you can value a company, and that is still true today with very much, the same methodologies that are around. Yes, there's new investment products around, and they will continue to evolve. Smart, beta, active ETFs, and then more and more will come. The private market is also very innovative with new products. But I think, there's nothing new to that, right? The industry will keep evolving. For me, when I was in the fortunate position to be able to hire a lot of people, and when I was at a big bank, and what I always looked for, and I would still look for, is passion. Mm-hmm. Does somebody have the passion for the industry? And depending, again, where you sit in the value chain, maybe you're more of a client person, maybe you're more of an analytical person. If you're like me, you usually don't go to bed before you see what the New York Stock Exchange closed and what the latest market news is, and it's usually also the first thing that I look at when I wake up in the morning. But it depends a little bit where you sit and what kind of passion you need to bring to a job. So I would say, those basic elements are still very much the same.
And something that we at the Society and CFA Institute really advocate for is clients' interest first. That's the mindset that everybody has to have in the industry.
Would add perhaps to that, if you're in a non-client-facing role, and again, coming back to technology, there's sort of two tools, but also threats that accompany you nowadays, and one is AI, and the other is near and offshoring, right? And I would be very aware of both. I think both can be very powerful tools. AI, if you're able to leverage it and use it, it can be very powerful, but it can also make us white-collar workers to some extent redundant, and the same with near offshoring. You can use it to your benefit, you can have blended teams or a smart combination, but sitting in beautiful Zurich with likely a nice salary, always also be very conscious of that and ask yourself, could that same role also be positioned in another country where it costs significantly less, and what value can I bring to justify being here?
Mm-hmm. And recently we have heard that young students, young generations, they're more interested in other industries, let's say tech industries. So Jakob, what do you think about the talent pipeline coming into our industry?
What do I think? I think it's probably drying up, but it's also drying up for others. But maybe the financial sector is true. Has become less popular than the tech industry, although now it's kind of a cycle where I wouldn't be too sure. If you go into tech, what are you going to do there? If you're going to be programming, you might be the one. You might be the first in line to get over, superfluous, because that can be really done very well with ChatGPT and other machines. So, but what do I see there? I see what I see for others as well. We have an aging population, and you have people who are moving out. I also still think of, although now it's become dangerous to mention diversity, but I'm still going to mention it. But I'm going to mention it in a really in a broad way. I think that multidisciplinary approach has a high value. If you get a team of people together who come from different walks of life, different disciplines, lawyers, economists, neuroscientists, and others, I think that really adds value because you get people who understand the world more fully. And there the talent is, I think talent is sometimes overvalued. We speak about talent if we're too lazy. If we just think we can find the person who is exactly fitting for that, we've been spoiled because we had a big market. But if you look at demography now, demography is the same everywhere. We have, or nearly everywhere. It's not going to be that easy to find the person who fits exactly into your job. So you need to think of training as well. So what is in the pipeline? I think there's a lot in the pipeline. Okay. There's a lot of people with a lot of knowledge. I mean, look at India, for example. Tremendous knowledge that coming up there all around, but we still have the demography, and just going elsewhere to recruit people, I don't think that's a sustainable solution because they all have the same problem. So, yeah.
If I have one more thing to add for maybe more young people these days, but networking. These days, everybody's on platform, and it's LinkedIn and Insta and Facebook, whatever it is, and it's a lot of times about how many followers you have. I know you got 5,000, you got 7,000, and so at the end of the day, what I say to people, it's how many of these people can you actually call up and organize a coffee with? That's your network. Mm-hmm. It doesn't matter if you have 7,000 or 70,000 or only 500 on LinkedIn, but it's much worth more if you have 20 or 30 that you can call up and they will react and come and have a coffee with you than if you have nobody. So I think that is also something.
And that's often very local then also in your industry for a physical meeting and not spread across the globe. Yes. Yeah.
So, Christoph, what advice then you give to your students?
In terms of what I guess, stay curious, keep learning. Traditionally, we saw sort of two skill sets in financial services: your technical skills and your people or sales skills. Right? Whatever you do, you need to sell it, and you need to have technical proficiency. And the third one that is now coming is technology. So be tech savvy to some extent. That doesn't mean everybody needs to become a Python expert, but at least be able to understand it, to interact with your technology counterparts and use that to your benefit. So some sort of tech savviness or ability, I think, is crucial.
Okay.
I think general knowledge is becoming much more important because of technological development. Because you still need to understand those machines and what they're supposed to be doing, because it's going to be garbage in and garbage out, at least to some extent.
Yeah, so, although I would maybe say, it's becoming more and more important to know how to formulate a prompt.
Yes, right? Of course.
Not
true.
To know.
I was working on that this morning.
You need to know how to formulate a prompt.
If you want to know, yes, but then exactly. But then you need to know the machine, and then you need to know the problem. If you don't know the problem, you will not get a solution.
Okay. Are there any questions?
Asking a question. Thank you. So you've talked about quite a lot of interesting topics. Thanks very much for that. One thing that came to mind is we've seen in other markets, you've seen private equity firms buying up wealth managers a lot. And it seems a few people have tried to do this in Switzerland. It doesn't seem to have maybe taken off as much as in, say, the USA. I was curious, do you expect that to happen a lot more in Switzerland? And how else do you think that could change the industry?
Wealth managers meaning banks or independent
So, I mean,
firms?
I think mainly I've seen it with a lot of financial advisors in the USA, to be honest. But I guess it could also happen more with private banks as well. I guess it would be possible.
Yeah, I mean, I think, we have seen some movement in Switzerland, but you're absolutely right. Not nearly to the extent that we've seen in other countries, and especially in the US and maybe also in the UK. I believe we will see more consolidation, in the industry. We've actually seen a few private banks disappear over the last 12 months in Switzerland. We've seen a few asset managers consolidate, being bought by other asset managers. So we've seen a bit of consolidation. I think it will continue because it's not about getting that FINMA license, it's about keeping that FINMA license, and there's quite a big cost for a lot of smaller entities to keep that running going forward. The structure that you need to have to be able to maintain your FINMA license as well. So yeah, I think we'll see more.
Yeah, I fully agree, yes. There was the same talk 2009, right after the financial crisis. People thought will all implode and will consolidate. Has not really happened. Yeah, there's platform models like Aquila and the likes offering platform services. I think there's a few consolidators now. Same thing, it's not a straightforward investment case, probably to some extent, but I think it will remain a diverse landscape, probably slowly consolidating, as you said, but not the big bang consolidation.
Well, we've seen fewer banks for sure.
Yes.
And not all the banks were actually bought as such, but you had some asset deals as well, also following the tax problems that we had. And then, those platforms maybe, because that's actually industrialization. You externalize everything that is about regulation. You have someone else doing it because you want to concentrate on other things. And I can imagine, because it's becoming more complex and more uncertain, it's maybe a good idea to outsource it and have it industrialized in some ways. Yeah.
Any other questions? No? I think the conclusion from discussion would be that the only constant is change, of course, and it's really up to us to invest in ourselves, to keep learning, to be able to foresee what the future will bring, and be able to quickly react on that. And so if you would like to hear more about the wealth management study landscape right here in Switzerland, please join Christoph's presentation. He will be in one of the rooms at 3:30. And if you would like to hear more about generative AI investment management, we are going to have CFA Society Switzerland presentation here tomorrow. And if you would like to read more on any of the topics that we just discussed, I highly encourage you to visit CFA Institute Research and Policy Center website. It's really a wealth of content, curated content, independent research, best practices, commentaries done by CFA charter holders. So I think it's a great place to continue the discussion beyond this panel. Thank you so much for joining us. And may I ask for a round of applause for our panelists?
Thank you.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory.